Hi, everyone. This is Dan Moorhead. I have my partners Joey Krug and Paul Bradataki on with me. We also have the entire investment team ready to answer questions in the chat box. Uh, First, hope all your families are safe and everything's okay with you. Um, this call, we want to address some of the issues we see and what's going to happen in the markets with this pandemic, and essentially just open it up for questions. We've prepared a slide deck with some of our bigger picture thoughts, but if you have a question, feel free to ask it real time in the group chat box, and we'll be answering it as we go. And then at the end of the call, we're happy to stay on the line and answer any questions you might have. The agenda for the call is hopefully to maximize the efficiency for those of you. We're going to go just very briefly into what Pantera is doing, the macro environment, how we think that impacts the crypto markets, and then for those of you who are investors in the funds, how we're changing the positioning in the funds, and then for those that want to go into a deeper discussion of the virus itself and how long this is potentially going to play out. We'll have some of that information at the end. The first thing is, Pantera is operating almost as normal. And the nice thing to report is even in the markets that we trade, there really have been very few disruptions. So our digital asset fund has an algorithmic strategy that trades every hour. And in crypto, that's kind of pushing the edge of HFT, basically. And we've had a couple little glitches here and there with service providers or exchanges, but it actually has performed quite well. And I think that really is a part of the theme of what we're going to talk about today, is that although crypto has been subject to this kind of emotional knee-jerk reaction that, oh, the world's coming to an end, asset prices are all down 30%, therefore crypto has to go down 30%. We think in a matter of just weeks, or the correlation, which we have historically seen in stress times, and we have a slide on this later, between crypto and the S&P or kind of general risk assets, will essentially decouple, and crypto will begin to trade on its own fundamentals. And for as disruptive and horrible as this pandemic is, it's probably net positive for crypto in the medium term, say 6-month type time frame. So the good news is, all of our operations are working quite well, and most of the exchanges and order routing services and entities that we use have been able to function quite well. With that, I'm going to hand it over to Joey to talk a bit about some of the issues he sees, and then I'll take it back to share some of the perspectives I have from 35 years of trading disruptions like this. Thanks, Joey. Take it away.
Thanks, Dan. So I guess the main thing that's really happened is, as everybody knows, coronavirus has been a huge black swan for really every market, not just crypto, but traditional markets as well. And what's unique about it is it's kind of causing really shocks on all sides of the system, both on the supply side and on the demand side. Because in many countries, or most countries now, people are basically either encouraged or forced to not go outside. So there's a huge decrease in spending, which we'll go over in a moment. And it's a sort of a huge tail risk event. A big pandemic like this really only happens once every 100 or 200 years. And so if you look at nationwide unemployment claims, just in the past couple of weeks, they spiked to roughly 700,000. Goldman and other banks are projecting that this week they'll spike to about 2 million in the past week alone. So it's a huge kind of increase in joblessness. There's a few businesses that do payroll for small businesses, and they basically stated that there's a decrease of about 60% in hourly workers of the small businesses that they have on their platforms running payroll. Half of them have actually just completely gone off the platform, basically decided they're shutting their small business down entirely. So the numbers on the small business side are pretty dire. And if you look at the macro environment, a really great insight into how little spending is going on is if you look at year-over-year restaurant bookings from OpenTable. This is something that we've been kind of paying attention to for the last 2 weeks. And if you look, about 2 weeks ago, things were down a bit compared to normal, but it wasn't super crazy. Things were down 10%. But now they're down about 99% to 100%, depending on the country. In places that have been hit a little less, like Australia, it's only down 54%, versus if you look at the UK, United States, Canada, Germany, etc., they're literally down 100% because most restaurants are closed in the United States as of today. I'm sure everybody knows this, but S&P is currently down about 25%. Oil went down below 20. So, on top of the coronavirus itself, there's been a huge oil price war between Russia and Saudi Arabia. And so there's a lot of pain occurring across all markets and really all asset classes. I remember about a week ago, there's one day where bonds, gold, oil, and equities were all down. And these are things that are supposed to be not super correlated, and every single one of them was down. And so as this sort of economic activity has come to basically a halt, there's two sorts of margin calls that have started to happen. They're both on the balance sheet and on the income statement side of things. So on the balance sheet side of things, companies are basically selling their leveraged financial positions to sort of fund liabilities. Lots of companies have a surprisingly short cash runway. If you look at airlines, most of the airlines have funding until mid-May. If you look at casinos, if they fire most of their employees, they have about 6 to 9 months of runway. And so there's a lot of these businesses that are really affected by these closures, and they're having to sell a lot of assets that they own to basically fund their current liabilities. The other side is the income statement side, where there's a huge decrease in revenues. And so again, companies are selling assets to fund expenses because their revenues basically just been shot, both on places that are in person. So physical stores are seeing a huge decline in revenue. But I think this will also start to ripple effect when many people who've lost their jobs now start to not buy things across the board. Versus right now, the sectors that are really horribly hit are cruises, airlines, hotels, restaurants. But as unemployment claims spike and start to go up, and they already have, we're just not going to see the numbers until Thursday this week. You'll start to see other businesses get hurt purely due to people's lack of spending kind of across the board.
And this, Dan, wanted to sit down to write our investors over the weekend, and I was thinking of a way to convey my concerns about the fragility of the supply chains in the world, and I think the huge impact this is going to have on the economy. And I was thinking back to that Milton Friedman book, Free to Choose, and he had a great analog of building or making a pencil and how interdependent it all is. And it seems to me that analogy is even bigger than I first thought. Is freedom to choose itself is potentially a negative at this moment in time. Having every person in every county in every state or even every nation choosing policies might be suboptimal. And that's why I'm actually very concerned about the economy, and then obviously its impact on our funds. Is this patchwork of choices is likely to have some pretty grave consequences. And I've seen a lot of different cycles over 35 years, some recessions, 87 stock market crash, all kinds of emerging market crises. But I think this one's going to be much larger than all of those. And we've already seen it. The S&P recorded its quickest bear market ever. It took just 15 days to go from its peak to down 20%. And the recent crash is twice as fast as the crash of 1921. So, the markets are really starting to wake up to this, but I think it's going to last. It's going to be much deeper and last much longer than most people think. And then unfortunately, when you've had the longest economic expansion in history, you know, a lot of kind of things get papered over in the cracks, and you know, there's probably going to be a lot of dislocations that are brought about. And I I, I enjoyed a Prescient op-ed in the New York Times a couple of like 6 weeks ago, and it said to take on the coronavirus, you got to go medieval on it, and that's essentially what we're doing right now. We're going back to very you know village-based economics, and the unfortunate corollary is medieval GDP was quite low. So I think we're going to have a huge hit to GDP. The simplest way to try and snuff out the virus is if everybody's self-isolated for 2 weeks, and governments around the world are trying various forms of that. Just doing the simple math, 2 weeks divided by 52 is essentially 4%. And I think that's a very good guesstimate of what's going to happen to developed world GDP. And this might even be the first time in recorded history that global GDP goes negative. Typically, emerging markets are growing so quickly, and there's areas that are unimpacted by a crisis that typically global GDP grows. Some firms like Goldman and JP Morgan are calling for a negative 1% on the globe, and 4 or so percent on developed markets like the US. I think that's highly likely to come to pass. And how that is typically counteracted is monetary and fiscal policy, which are trying to typically counteract a lack of demand or a lack of credit. This thing is a physical and invisible barrier to doing business, so it's completely different than previous policies. Monetary policy had already gotten to zero in most countries. In the previous global financial crisis, the US was able to cut 438 basis points. We only had 150 left in its weapon this time. And in the global monetary policy impulse last time in the global financial crisis was almost 300 basis points, and it's expected to be only 55 here. So, when rates are already really close to zero, there's not a lot you can do. And then monetary policy itself, I commend the Fed for all they're trying to do, but I really think it's going to have very little impact against the economic and psychological damage that the pandemic has. If you think about it, it's like if the Fed cuts rates 100 basis points, that's not going to induce you to want to go to the movie theater. So it's going to be very difficult. The fiscal side, huge, just actually staggering amounts are being discussed. Its impact on our markets here are the US was already running a massive fiscal deficit in the absolute best of times, essentially zero non-functional unemployment, record expansion, record stock market, record property markets, and the US was running a large deficit. We're now talking about 6 or 7% of GDP in spending in excess of receipts. And its impact here on our business is when you're essentially printing money or easing the quantity of money in order to inflate the price of non-quantitatively easable things like stocks or real estate, it has a similar effect on things like Bitcoin that have a fixed quantity. And so although I totally understand the impetus to have crypto sell off in this panic, I think in 12 months time, crypto is going to be at a new record and have done very well, because we're talking about adding the numbers that are debated right now are $1.8 trillion in fiscal stimulus. That's 50% of the total M0 money supply of the United States. And it's a huge fraction of the M3, which is about 16 trillion. So when you have a huge number of extra paper dollars chasing any fixed asset, whether it's Bitcoin or stocks or real estate or whatever, it has the impact of pushing up the value of the things you can't increase the quantity of. And I do think that you'll see crypto performing some cases like crypto exchanges are functioning well generally. So I think the fundamental value of crypto will come through in this, but just the simple fact of increasing the number of paper dollars, the exchange rate between paper dollars and crypto should go up. And with that, I'm going to hand it back to Joey to talk about specifics in the crypto market.
Thanks. So if we look at, crypto as an asset class, common misconception people have is that, Bitcoin serves as like a risk off safe haven asset. And it's actually a misconception people have about gold to some degree as well. And while we think that's true over the, long term, uh, during a huge kind of spike in volatility and steep downturn, that's not actually true. So what happens is, during these huge volatility spikes and downturns, when people are selling everything, they sell everything. Bitcoin, even gold saw a bit of a sell-off over the past week. Now it's started to rally again. But basically, people sell everything they have for cash, and because people are looking to get liquidity, and so crypto is no exception to that. So if you look at this slide, if you look at Bitcoin, it's uncorrelated and trending in range-bound markets. So when the market's kind of trending down in the S&P, or the market's trending up, or when it's kind of range-bound, crypto is pretty uncorrelated. But during crisis moments, for a period of weeks or a couple of months, when something really goes down or sometimes up a lot, there's a pretty high correlation between Bitcoin and assets like the S&P 500. And to make this point, even treasuries last week saw sell-offs on some days alongside equities. And so the punchline here is that Bitcoin remains essentially non-correlated over the long run. That doesn't mean that it's not going to have correlations over short-term cycles, is sort of the main point to take away from that. And we can go back to the last slide and look at sort of how the market reacted to COVID-19. And sort of highs for crypto and Bitcoin were February 11th, sort of preceding the S&P 500 high in February 19th. And since the 11th, most assets in the space are down about an average of 50%. Bitcoin's down about an average of 39%. And the way to think about that is Bitcoin is sort of a safe haven within crypto. As the perceived risk of Bitcoin is lower than other cryptocurrencies. And the reasons for this are sort of obvious. It has the longest track record. It's the most widely owned. It has a guaranteed fixed supply. It was the original cryptocurrency. It's the most liquid. People tend to go into it during a period of fear. And so you kind of have two classes of actors. You have actors who are selling everything to cash. And then you have actors who are going to sell some of their other cryptocurrencies for Bitcoin and just stay in Bitcoin for a while. And so that's why you see, Bitcoin's decline is less relative to other things in the space. And the other kind of big element that somebody mentioned in the chat is there wasn't just sell-side pressure from coronavirus or sort of the impending US recession. There's also a lot of sell-side pressure due to two other issues. And if you looked at, I think it was March 13th, there's a huge decline in Bitcoin's price, where Bitcoin went down to 3,800. And there's sort of speculation about a couple of reasons for why that happened. One of them is that there's this Ponzi scheme called Plus Token. That was a Ponzi scheme, I think, in China. And they basically stole a bunch of Bitcoin from their users and have been kind of slowly selling it off over time. And Chainalysis, which does a bunch of research on this, showed that about 13,000 Bitcoin were moved out of Plus Token wallets into mixers on March 9th or March 5th. And they've sort of been steadily selling them into the market since then. The other element, which is a much bigger element, is on the next slide, which is the BitMEX DDoS attack, or distributed denial of service attack. And so what happened here is that BitMEX, which is a big exchange and most importantly derivatives platform, was attacked, where basically trading was sort of forced to halt because their servers went down. And what happened is a huge series of margin calls occurred that led to a liquidation of about $1.2 billion in long positions, which is a really significant amount. They do about $20 billion of total crypto trading volume in a given day. And so 1.2 billion of liquidated positions in a span of 30 minutes is just a huge number. And so we think that's what drove a large portion of the price decline from 6,000 to 3,800. And if you look at the trend line for Bitcoin, right now, Bitcoin is significantly below its 9-year logarithmic trend. So this is when you kind of chart returns in a logarithmic fashion. And it's currently at its 3rd percentile. If you look back in December 2017, it was like, well above 200%. Mid last year, it was maybe, 10, 15% below its peak, below the median trend line, kind of during the peak of the market last year. And right now, it's about, 3% in terms of its percentile ranking. So Bitcoin is very cheap relative to its historical trend line.
And Joey, I want to add a few thoughts before we go on to the specific funds. Our overall view is that, yes, the stressed markets, as Joey showed in the correlation graph, Bitcoin does gap down, or all crypto do gap down with the stress, but we think it's only a period of weeks, and we reduced risk in our actively traded funds when the markets were gapping down, but we've actually already covered most of that risk reduction because we think we're through the kind of 2 or 3 week period where kind of emotion prevails, and that we'll now get back to a point where crypto can trade on its own fundamentals. The big overarching views we have are that from now on, crypto can trade on its own fundamentals, and it'll probably be in this whole cycle much higher than it even began. And that Bitcoin will probably outperform for a while for some of the reasons Joey said, but also essentially it's a project that's already done, it's already built, it already works, it has an 11-year track record. A lot of the smart contract projects are still in development and might be stressed to raise funding to complete the development. There's always a kind of flight to quality where people want to put money in the mega caps or the T-bills or the treasuries of the industry. And when people are trying to sell stuff, Bitcoin's much more liquid than everything else. And so we have dramatically increased our Bitcoin exposure and taken down our risk in other stuff. And then the other view we hold is that tokens are going to outperform venture. Tokens reprice instantaneously, and so they have much more volatility, both on the upside and the downside. And venture is a much more of a slow-moving pricing mechanism. The venture markets lag the public equity markets by 3 to 6 months, and so you essentially just see the number of deals dry up in venture rather than the pricing. And then 6 months later, when both sides finally agree on where the supply and demand curves reach, you'll see the number of deals pick back up, but at much lower prices. So our dominant view is right now, tokens are probably going to outperform venture, and Bitcoin is going to outperform other tokens in the kind of near term. And with that, I'll hand it back to Joey for the specific funds.
Yeah, so if we look at the digital asset fund, we've made two adjustments to the strategy. One is increasing exposure to quantitative strategies to 30%. And the thinking behind that is that our quantitative strategies can trade, essentially all the time, and they're trading on an hourly basis. So, while we may not be up at 3:30 in the morning able to take advantage of a great trade, our quantitative strategies can do that, and more importantly, it's easier for them to dynamically sort of go long short. Now it's still long biased, but I'd say net exposure is kind of hovers around 70 to 80% versus 100% that you have in the discretionary strat. And the other element is that the quantitative strats can also hedge by shorting assets other than just Bitcoin. They can borrow other more volatile assets to short and form a more dynamic portfolio based on that. So we bumped those up to 30%. Didn't want to go higher for 2 reasons. One is we're still working out a lot of infrastructure challenges to scaling that strategy, and then 2, want to make sure it's more proven out before continuing to increase it. by looking at how it's doing and when it's 30% of the fund versus 20% as of a few weeks ago. The second piece is discretionary rebalancing farther into Bitcoin. So our current Bitcoin position is about 33%. And the thinking behind that is exactly what Dan mentioned, where Bitcoin dominance tends to increase. And so if you look actually relative to S&P 500 drawdowns, Bitcoin dominance has increased historically after those. In fact, it grows about an average of 8% over a 4-month period when the S&P has declined. And if you look at Bitcoin dominance since we did that trade, it's up about 4%, from just under 62 to just under 66%. And so it looks like about half of that historical average movement has already happened since we made that decision. That's a chart that basically just kind of explains visually what I just said. And then Paul's going to talk about what we've done on the venture and ICO side for a moment.
Hey guys, this is Paul. So in terms of the venture and ICO funds, the overall strategies don't really change, but we are going to be looking at things with a lens, using sort of what's going on in the global environment and making sure that that's factored in. So, I think in terms of use cases, really focusing on use cases and maybe even advising some of our companies to, use what I think are going to be use cases that thrive during this environment: speculation, digital payments, and either incorporate that or potentially move into that. Think companies that can really use those use cases to their advantage, I think will benefit during this time. Especially where there's going to be a lot of volatility and there's going to be a lot of e-commerce payments, digital payments for things, as we're sort of moving out of the social interaction world. And we are still going to be looking at use cases outside of those two, but it's going to be really guys that have the right team, guys that have a certain advantage within a certain sector that can manage runway and be able to come out of this time period in a very strong way. In terms of helping our portfolio companies, we're doing a few different things. We're having a portfolio-wide call next week, similar to what we're doing right here, giving a presentation on the markets and really diving deeper into how we can be helpful to them, different strategies that we're seeing, and potentially just connecting them together so that they can share strategies that they are doing and learning from their experiences. Everything from how to work remotely to how to close deals to how to fundraise. Where we're advising them on, what to do in terms of teams and managing teams and staying lean, to renegotiating office space, reevaluating vendors, and then also being able to forecast different scenarios, sort of a conservative scenario all the way up to an optimistic scenario, and making sure that they have the cash and resources for each of those scenarios. And then, of course, going through our portfolio, knowing that, companies that were about to fundraise or companies that, need a little bit of capital right now, we're making sure that we can rank all of the companies and, be able to sort of decide where capital should be deployed from Pantera side, and then also help brainstorm on different ways of fundraising, either from crypto native VCs to traditional VCs to maybe even certain types of crowdfunding that could be applicable for their business. And then, of course, we're going to see companies, just naturally running out of cash, and we're spending a lot of time trying to find companies a good proper home. So spending a lot of time doing some mergers and acquisitions, working with other bankers, working with other folks in the industry, working with other exchanges and wallet providers and guys that need some of these technologies, need talent, need licenses, etc. And then, of course, on the existing deals, we're going to be evaluating every single one that we were about to close and making sure that they are priced appropriately given certain market conditions and given how this could affect their bottom line, and making sure that we are getting a fair deal. And then I think lastly, we're expecting a lot of great companies to come out of this period and then be generational transforming companies. And therefore, for us, as Dan mentioned, it takes about 3 to 6 months for the venture market to sort of reset and price itself correctly compared to the liquid markets. And therefore, being one of the larger funds out there, being a fund that has a lot of dry powder, we can be patient and wait a bit and see the markets reset. And I think for us, because we've been doing this for a long time, we know what to look for. We have theses on what we want to invest into, and therefore, whether they are existing companies that are already out there or new companies that come up, we think that being patient, getting in at potentially favorable valuations during this time and in the near future, we'll be able to have the ownership percentage in the right companies that will be tremendously successful.
Thanks, Paul. So the next thing we're going to cover is, some basics on the virus itself, and also other things we're looking at sort of for monitoring the situation. Because this huge sort of macro slowdown is triggered by a pandemic, it's pretty unique in terms of, historical scenarios. Like you look at 08, that was a financial crisis, had nothing to do with healthcare. But this time it's pretty different. And so since most of the country is shut down in the US, and same thing is true across many other countries, it's important to kind of look at and figure out, when do we think this is actually going to end? How long will it last? How severe will it be? That sort of thing. And there's really two main metrics that people are looking at. One is called R0, which is how many people infect another person if they have the virus. And so, the kind of current data shows that the R0 for coronavirus is about 2.5. That assumes you do nothing. So that means if you were to get it, you would on average infect about 2.5 other people. That assumes you don't do this sort of social distancing that most countries are doing. It assumes that you kind of continue on as normal. If you shut things down, like China did pretty early on, that number drops a lot. And assuming you can get it below 1, the virus eventually dies out because it stops growing. The second number is what's known as the CFR, or case fatality rate. And this is the percentage of people who get the virus who die from it. And the CFR is right now is about 3% globally. In the US, it's about 1.25%. In Korea, it's roughly 1%. And there's a few things that play into that. One is how overwhelmed is the country's medical system. So if it's very overwhelmed, that number can skyrocket. Like in Italy, the CFR is about 10%. Another element that can cause it to decrease is undiagnosed cases. So if for every one person who has the virus, there's 4 others who have it and aren't even bothering to get tested because they feel so normal, then that would lower it by about a factor of 5. And so there's a lot that we don't know there, and being able to figure out more is sort of waiting on additional data that the government would need to get. If we go to the next slide, you can sort of look at, based on what the government is doing right now, which is trying to do widespread testing, ending large gatherings, social distancing, encouraging people not to go out, that sort of thing. Most projections show that there'll be about roughly 500,000 cases at the peak and roughly 60,000 total deaths. These are in the United States. For comparison, the 2017 to 2018 flu season, which was a pretty bad flu season, was about 60,000 deaths or so. And so this assumes that we continue to stay shut down. If the country reopens, say next week, all these numbers could be drastically off. And so if we look to the past, we can see what happened in the 1918 Spanish flu. And this is a pretty telling picture. It shows the difference between Philadelphia and St. Louis. So in Philadelphia, they didn't do any of these measures, and the death rate per 100,000 people was 250. If you look at St. Louis, which did, the death rate, over that same period averaged below 50. So it was 1/5 death rate of the country that, or sorry, of the city that didn't do anything. And so doing these measures is really important. If we go to the next slide, the most important thing to look at is how things are going in China, because China is much further ahead of the curve than the United States. Another country to look at is Italy. And in China, the thing to pay attention to is what happens when they start reopening stores, restaurants, factories, and other businesses. And there's sort of two elements to China. There's, outside Wuhan province, and there's inside Wuhan. And outside Wuhan, the numbers don't really matter that much because there are so few people who got coronavirus outside of Wuhan that, it's almost a certainty, I would say, that it doesn't continue to spread outside. The more relevant question is what happens once Wuhan starts reopening all of these physical locations and people start going out again. And if the curve essentially stays flat, if the number of cases don't really increase very much, that's a very good thing and bodes very well for the US and Europe. If it doesn't, that means a lot more pain over the next few months, both in the markets and literally. And the country that's another one that's relevant one to look at is what's going on in Italy. And the reason Italy is relevant is they are much slower to act than China and South Korea. And if you look at Italy, they acted about kind of on the same pace as the United States. And so whatever happens to numbers there is sort of going to foreshadow, I think, what happens in the United States. And over the past few days, Italy's number of cases in percentage terms have been decreasing. So the percentage of cases that they've been getting has, started to decrease, which is a very positive thing. If you look at China, their percentage increases started to decrease. That took a few weeks, and then the absolute number of cases started to decrease as well. So I think that's a very kind of positive thing for the rest of the world. If you look at this slide, this shows the Spanish flu versus the Dow Jones Industrial Average. And, there's a few things that are very different this time. One is that we have modern medicine. Two is that we know what like a flu actually is and what a virus is. Back in 1918, people didn't even know what viruses were. And tons of places didn't implement social distancing. They didn't implement all these measures that we've implemented this time. So I think, the first thing to say is that I think it's going to be orders of magnitude better than what occurred in 1918. And as an example of that, if you look at the swine flu, which was very, very similar to the virus in the Spanish flu from 1918, the death rate was very low, and things ended up being pretty fine after the end of that. And so this time, what's different is coronavirus does have it's more virulent than the swine flu. It's more severe, but we've also been much more severe in the measures we've taken to slow things down and to really halt the spread. And so if you look at China, South Korea, and even Italy, which has gotten pretty bad, but it's starting to improve, I think it's going to end up pretty good over the course of a couple months. It's going to be a rough period, but it's not going to be like what a lot of alarmist headlines say, assuming that we continue to be really careful about it from like an epidemiological standpoint. And on the market side of things, everybody knows there's a huge supply chain tie-up, there's a huge global demand shock, people literally can't go outside. But once these conditions get lifted, it should start to bounce back relatively quickly. And if you look at the 1918 Spanish flu versus the Dow, the market went down about 11%. The context that's missing from this chart is that in 1917, basically prior to this 11% decrease, the market went down about 45%. So the total decline was about 50-something%, and then it rebounded pretty quickly in the beginning of 1919. And so if we start to look forward, there's really a few different things to look at. Um, we're continuing to monitor all of this stuff, both on the numbers side for the virus itself and also from the economic standpoint. And there's a few different things you can look at for, when does it start to actually bottom and start to improve? And, one of them is when cases begin to peak. I talked a lot about this earlier, but the idea is that, Italy should, based on the data, peak within the next 1 to 3 weeks and then start to decline. And in that case, that would mean the US would probably peak sometime in April, so sometime next month. So it's not like this is going to last forever. The second piece is drugs that lower the fatality rate. So there's a bunch of different drugs in trials, and it kind of remains to be seen how those will actually work. New York City is actually testing a lot of those, so we'll have good data on that probably in about a week. If that happens, that'd be a hugely positive things for the market. Next kind of catalyst for a bottom is sort of like, level of fear. People actually do need to stop going outside for this to actually end. If you could kind of wave a magic wand and everybody didn't go outside, it would disappear very quickly. And so that's sort of another metric. Next one, this one sounds kind of quaint because I wrote these criteria about 10 days ago. It says, if it's greater than $1 trillion in stimulus and $250 billion in bailouts. The current stimulus and bailout numbers are looking more like 2 trillion and 500 billion. The next one is sort of like when the S&P sort of begins to hit a bottom. We start to see bad Q1, bad employment numbers. And I think in terms of crypto, the main thing to look for is, despite whatever the S&P 500 is doing, is Bitcoin maintaining above its 5K trend line? And if that's the case, I think that's a very positive thing for crypto. If you look at institutional adoption, I think that's going to be delayed as a result of this shock. A lot of institutions are kind of now questioning whether Bitcoin is really a non-correlated asset class. I think it's because they probably just hadn't thought about the fact that it's correlated with everything else in a huge downturn, but will become uncorrelated in the upswing. And so I think as the upswing starts to happen and it begins to decouple, that's going to be a really positive sign for institutions. I think we might see them start to put on exposure to crypto after that. Last piece on this is the halvening. So the idea is that, as the supply starts to decrease into the market every day for miners, institutions could begin to identify it as a really positive asset to start to put risk on after, we sort of bottomed out in traditional markets. And after that, Dan's going to talk about fiscal policy and what's going on there.
And thanks, Julie. I'll stay on this slide for 1 second because there was a question from one of you all on institutional adoption. I would think my instinct is basically all institutional investors are going to go into a 2 to 3 month kind of triage mode where they don't do anything new. They just go through their portfolio. They see, what is something they need to change or cut. And then they're going to have a period of say 3 to 6 months where they look at going forward strategies and how to be taking advantage of these opportunities. And then we'll start committing capital to things like crypto. There are going to be other, like distressed lending is a business that I've been around for a long time. And, the last 10 years were terrible for that business because nothing was in distress. This is going to create enormous distress situations. So I think it's going to be a couple of months before institutions really start looking at proactive things to do. But once they do, I think crypto is going to be in the bucket of, interesting opportunities rather than things that need to get cut. And for most institutions, they literally only had basis points in crypto so far. So it's not like, there could be a very meaningful cut because it's already, almost de minimis. And on the next slide, it's just a visualization of how difficult it is for fiscal policy to buffer this problem. As I said before, most issues are a lack of income or a lack of credit. And right now it's just a lack of a complete physical barrier to customers wanting to do business. And the typical small to medium-sized business has about 27 days of revenues in cash on their balance sheet. And so, if the economy is shut in for, many more weeks, it's really going to have a serious impact. And enacting a fiscal policy to counteract that's just mind-bogglingly difficult. It's going to be very hard to target it and get the money to people quickly enough. It really is going to be it's a tricky act that the politicians and executive branches of the world have to do. To put this in perspective, this will be the largest stimulus since World War II. The Great Recession in 2008 was about 6% of GDP, and we're now talking numbers way, way above that. This slide's a day or two old as well, so it's out of date. But my worry is it's gonna be very hard to pinpoint the printed money to actual use cases that work. In the $850 billion stimulus of the 2008-9 era, John Taylor of Stanford calculated only about 1% of it actually increased infrastructure in the United States. It's a very, very hard thing to do to pinpoint policy. On the next is a graphic that we've had shown in the past of the decline in the value of the dollar relative to things that can't be quantitatively eased. That's the value of the dollar. It's basically the price of these things inverted, which is then now the price of the US dollar based in terms of things like gold, how many ounces of gold it takes to buy a dollar. Having run massive structural deficits into a really fantastic set of circumstances, and now opening the floodgates, I think is unambiguously great for cryptocurrency asset prices. And then the last is a graphic of the monetary increase in the United States as a proxy for the rest of the world. As you increase the quantity of paper money, it takes more pieces of paper money to buy things that are fixed assets. That's just old school supply and demand graphs from Econ 101. And there was a question about, will quantitative easing increase inflation? I would say definitely yes, but it really depends on your definition of inflation. Sometimes people use a narrow measure like the CPI basket, which is a measure of fixed goods like, flat screen TVs and things like that. I don't think there's actually going to be much inflation in those because there's so much massive excess capacity in the world and excess labor of people coming into the developed world. But the complete and obvious intent of these policies are to inflate the price of things like stocks and real estate. I think they will do that. They'll blunt the decline in the price of stocks and real estate. But the corollary is they'll also inflate the price of other things like digital gold and other cryptocurrencies. So I think it will have a big impact on cryptocurrency. And the last is just kind of a final thought before we answer a bunch of these questions, a lot of great questions, is Bitcoin itself was born in a financial crisis. That's what Satoshi was trying to do. And I think it really will come of age in this one. It's going to be a bumpy next 6 or 12 months. There's going to be a lot of really wild things that, unprecedented things that none of us have dealt with in our careers come out. But I think when the dust settles, crypto will have proven to be really good at moving money around the world, really good at storing your wealth, way better than, paper currency. And so, obviously it's a shock to everyone. It's hard for all of us to get our heads around it, but I think that once the dust settles in say 6 to 12 months, Bitcoin will have, and all cryptocurrencies will have proven that they are superior to some of these centralized systems that don't work very well and will have done quite well. And with that, I'm going to try and answer a bunch of the questions that I've seen pop up that have not yet been answered. And then, our investment team's happy to stay as long as we have questions. There was a question about negative interest rates having an impact on stocks and housing prices. It seems to me that most central banks have realized that negative interest rates really aren't very effective, and that zero is essentially the lower bound, maybe a slight negative, but I'm not aware of any major central bank that thinks they can take rates substantially below zero. And the Fed's pretty clear. They have now come down to zero a handful of times, and each time they set their target for 0 to 25 basis points rather than if you know, like in the previous global financial crisis, the US cut 438 basis points. If we did that again, assuming, I think this is going to be an even bigger economic shock, that would bring rates to minus 3.0. I really just don't think that any central bank, including the Fed, is willing to do that. And the Fed buying ETFs and things like that, you know, they're going to try and extend credit and try and, you know, blunt the force of this thing. But I really think it's going to be difficult, unfortunately. And a perspective I would have is, you know, I started out as a bond trader, and the quote best times for bonds are always the worst times for everybody else in the economy. And so it's kind of like that here in crypto, that all of these terrible things that are going on in the world are probably net positive for the cryptocurrency asset prices. And so the Fed buying all these things, it's going to help a little bit, but I really think it's not going to translate very well. That, you know, people are not doing commerce because they're avoiding a physical enemy, a virus, rather than, you know, they don't have access to credit. There was a question about what things will be successful here, and will lending platforms. That's an interesting question. It's a great question. I think that lending platforms will ultimately do well in this, but there's been some issues with MakerDAO and others being essentially hostage to the low throughput of the main blockchain, Ethereum. And so if Ethereum can only do 10 transactions a second, and 30 million people are all trying to modify lending agreements at the same time, it's not going to work very well. What it is already working quite well for is remittance, and that is allowing, because you know, there are not so many people trying to margin call people all at the same time. So I think remittance and wealth storage are the things that, you know, Bitcoin's going to do or blockchain's going to do quite well here. There's another question about our quantitative strategy within the digital asset fund. Is there a fixed percentage that we desire to have? And I'd say no. It's an evolving ratio based on two things: our confidence in our models, which has been increasing over the last 12 months, and then the opportunity set. And this market is perfect for quantitative trading. All kinds of crazy dislocations are happening at rates that are faster than, you know, humans can keep up with, especially monitoring, you know, across the 20 or so different exchanges we trade in. And so the models, we increased the models specifically because of the opportunities that we're seeing. The models recalibrate potential opportunities every hour, but they're not forced to trade every hour. So if there isn't anything to do, you know, they are essentially on hold. There was another question about Bitcoin halving. Our stated view is the same. We think it's going to be positive net. You know, there's the efficient markets theorist, you know, dogmatic statement that if we've known about it for 10 years, then how it's going to have any impact. And I'd written about this in our investor letter. It's kind of like the Warren Buffett line, that the difference between the markets always being efficient and often being efficient is worth $70 billion to me. It's kind of my view here. So we all know the halving is going to happen, but I still think when you come to a day where the number of Bitcoins that are sent into the bid and offer is half as many as yesterday, it will have a positive impact on the price. And Joey did a slide a while ago showing that in the past two halvings, it's definitely had an impact. I think it will again here. There was another question about miners. You know, I've never really been a big believer that like there's any kind of specific technicals that impact miners. Most miners, you know, have a program to sell all the Bitcoins and other currencies they receive for processing transactions, and then buy more machines, more hardware, more electricity. And there are back in the day, 6-8 years ago, there were some miners that were mining specifically to build up huge stockpiles of Bitcoins, but most miners are just commercial in nature, and they just sell the Bitcoins and buy more machines and more electricity so they keep going. And with that, I think we've answered all the questions that were open. We definitely will take more questions on the web chat, but if you want to ask a question verbally, you can raise your hand and we'll unmute you and answer the question there. And while you're thinking of further questions, if you do have questions for us, we're always available. Our general email is IR for investor relations @PantheraCapital.com. And then our IR colleagues can route it to Lauren or William or Joey or Paul or me or whoever you're looking to get in touch with. Oh, and the question about from Jason Leibowitz, good to hear from you. How do we see Bitcoin fitting into traditional investment portfolio? I've been in business long enough to see a lot of new asset classes, like commodities used to be completely random, and now they're like considered a normal asset class. Real estate's often now considered an asset class. Alternatives used to actually be alternative, and now they're just kind of a normal thing that's in everybody's portfolio. And the same thing, even like real assets like timber or whatever. And I think crypto is going to go through that same evolution over the next. It's going to take a decade, but I think in 10 years, every major endowment is going to have their own crypto team, and they're going to have an express allocation for crypto. And so, this crisis here is going to set that back 6 months maybe, but it certainly will come to pass. Yeah, and the question on equities performing well in high inflation environments, I actually am not calling for a high rate of inflation in CPI because you can make as many flat screen TVs as you want, but there will be a great amount of inflation in things like gold or stocks relative to the price today, or real estate relative to, if you want to sell real estate today, you're probably selling it, down a huge fraction from 4 weeks ago. The amount of money that's being printed right now will mitigate that reduction. And so there's going to be a lot of inflation in cryptocurrencies, gold, stocks, real estate relative to what would happen otherwise. But I'm not calling for a lot of consumer price inflation. The source of the chart showing small businesses with 27 days of cash is by the JP Morgan Corporate Something Institute. And we will send the slide deck out to you all, and all of the sources will be listed so you can check it out. So I think we've answered all the questions. I want to thank you all for joining the call. We want to be super transparent through all this. So for those of you who are LPs, we'll always be pumping out the usual information. For others, if you have questions and you want some insights, shoot us an email at ir@panteracapital.com. Thank you so much.